Knowledge Group webcast, Heightened BSA AML Compliance, Challenges in 2017 and Beyond. I'm Sal Giangrasso, your moderator for today's event. Now let's introduce today's speakers. Ross B. Hofherr. Ross is a senior associate in the New York City office of Harris Beach PLLC. Ross is co-leader of the Regional Financial Institutions team and a member of the firm's Financial Institutions and Capital Markets Industry team and the Government Compliance and Investigations Practice Group, as well as the Mass Torts and Industry-Wide Litigation and Business and Commercial Litigation Practice Groups. And now we're turning the conference over to Ross Hofherr. And Ross, you will also have your fair share of time, which should take us up to about, I'd say about 48 past the hour, and then we'll go to the Q&A. Should you need the 33 minutes, Ross, it's up to you. Please go ahead.
Thank you, Sal, and thank you to everyone at the Knowledge Group for putting together such a great program. Thank you to Matt and Ann for your excellent presentations. And most importantly, thank you to everyone for attending this webinar and for sticking it out until the last speaker. As Sal just mentioned, I believe that was the fourth secret word, which means that I have a captive audience because you need at least, I think it's 2 more secret words. So stay with me and hopefully you'll stay through to the question and answer session. Today I'm going to talk about FinCEN's Customer Identification Program and Customer Due Diligence Rules, the New York Department of Financial Services regulation on transaction monitoring and filtering, FinCEN's recent expansion of geographic targeting orders for residential real estate, and 2 recent anti-money laundering enforcement actions brought by the New York Department of Financial Services and by FinCEN. If you could turn to the next slide, please. The Customer Identification Program rule was enacted in 2003 as a joint rule by the U.S. Department of Treasury through FinCEN, the FDIC, the Federal Deposit Insurance Corporation, the Board of Governors of the Federal Reserve System, the OCC, that's the Office of the Comptroller of the Currency, the OTS, the Office of Thrift Supervision, and the NCUA, which is the National Credit Union Administration. The rule was enacted to implement Section 326 of the USA Patriot Act, which was legislation passed just after September 11th, 2001. The Customer Identification Program rule requires federal banks, savings associations, credit unions, and certain non-federally regulated institutions to implement programs designed to verify the identities of customers who are opening new accounts. Next slide, please. Specifically, subject financial institutions are required to implement a written risk-based customer identification program. They're also required to maintain records, which include customer information and methods used to verify customers' identities, to compare the names of new customers against government lists of known or suspected terrorists or terrorist organizations. For the purposes of the rule, a customer is defined as a business or individual who opens a new account, also includes an individual who opens a new account on behalf of another individual who lacks legal capacity, such as a minor, or on behalf of an entity that is not a business or individual, such as a civic club. Notably, the definition of consumer does not include a financial institution that is regulated by a federal functional regulator or a bank that is regulated by a state bank regulator. Customer also does not include publicly traded companies, companies that perform certain governmental functions, or a customer that has an existing account with the institution, provided that the institution has a reasonable belief that it knows the true identity of the person who has an existing account. At a minimum, the institution must obtain from each customer before opening an account the customer's name, if it's an individual, the individual's date of birth, the address, and the identification number, which in the case of an individual is a social security number, in the case of a business is a tax ID number. Each financial institution is tasked with conducting a risk assessment of their customer base and product offerings, and in determining the risk specific to that institution, they have to consider the types of accounts that are offered by the institution, the bank's methods of opening new accounts, the types of identifying information that are available, the institution's size, location, and customer base, including types of products and services used by their customers in different geographic locations. The risk assessment, as Anne alluded to and went over in her segment, the risk assessment is specific to a given financial institution, and the unique risks that a financial institution faces should be considered when implementing a customer identification policy, and the financial institution itself is best situated to know what information they should require beyond the minimum requirements of the Customer Identification Program rule. For example, most financial institutions have Customer Identification Program policies that require Social Security numbers from account signatories or control persons when opening business accounts. Technically, this is not a requirement of the Customer Identification Program rule, but financial institutions can impose stricter requirements on their customers and are obligated to do so if appropriate given their specific risk assessment. Now, the new customer due diligence rule, which I'm going to talk about next, does require Social Security numbers for control persons when opening business accounts, but the historic Customer Identification Program rule does not. Financial institutions should always follow their written Customer Identification Program policies, because regulators will look to these policies to ensure that they're being complied with. And consumers or bank customers will demand these policies in discovery should litigation be commenced for any sort of claim that the customer was wrongfully denied an account being opened for, let's say, fair lending reasons or anything along those lines. Next slide, please. On May 11th of 2016, FinCEN issued the customer due diligence requirements for financial institutions, which require financial institutions to perform customer due diligence to determine the identities of beneficial owners of their legal entity customers when either a new account is opened or when there is a change in beneficial ownership of an account, if such change would be relevant to assessing the risk posed by the given customer. Covered financial institutions include federally regulated banks and federally insured credit unions, mutual funds, brokers or dealers in securities, futures commissions merchants, and introducing brokers in commodities. The customer due diligence rule identifies two distinct types of beneficial owners. First, you have each individual who directly or indirectly owns 25% or more of the equity interest of a legal entity customer. This is known as the ownership prong. The second group of people are any individuals that have significant responsibility to control, manage, or direct a legal entity customer. This would include executive officers or senior managers. The examples given are a chief executive officer or chief financial officer, a managing member, a general partner, a president, vice president, or treasurer, and this is known as the control prong. This list of positions in the control prong is illustrative and not exclusive, as there is significant diversity in how legal entities are structured. Other individuals who regularly perform similar control functions should be considered to be beneficial owners as well. The customer due diligence rule applies to accounts opened on or after May 11th of 2018, or to accounts with changes in beneficial ownership on or after May 11th of 2018, and requires financial institutions to establish and maintain written procedures reasonably designed to identify and verify beneficial owners of their legal entity or customers, and requires financial institutions to establish and maintain written procedures reasonably designed and verify beneficial owners of their legal entities. The elements required for verifying the identity of customers that are individuals under the Customer Identification Program need to contain, again, elements required for individual name, under the Customer Identification Program, residential or business address, those are the individual's name, in the case of an individual, residential or business address number, or in the case of a business, in the case of individual, a tax ID number, or in the case of business, a. So, in that way, the customer due diligence rule refers back to the requirements of the Customer Identification Program. To the requirements of the Customer Identification Program. Next slide, please. The New York Department of Financial Services has also established regulations on transaction monitoring and filtering. The New York DFS was created in 2011, combining what was historically two separate departments, State Banking Department and the State Insurance Department. The current superintendent of DFS is Maria Vullo, and under her leadership, DFS has been very aggressive towards regulating financial institutions. The common misperception is that DFS is a branch of the Attorney General's office, but actually DFS falls under the purview of New York's governor. New York is somewhat unique in that regard, in that we have three officials that have a reputation for being tough financial when it comes to regulations. We have Governor Cuomo, Attorney General Schneiderman, and Superintendent Vullo, whereas most states with a similar reputation have only one official, like Attorney General Healy in the state of Massachusetts. The DFS regulation on anti-money laundering, the transaction monitoring and filtering regulation, went into effect on January 1st of 2017, and it applies to all banks, trust companies, private bankers, savings banks, and savings and loan associations that are chartered pursuant to the New York banking law. It also applies to all branches and agencies of foreign banking corporations that are licensed pursuant to the banking law to conduct operations in New York. The regulation also applies to non-bank entities, check cashers, and money transmitters that are licensed pursuant to the banking law. Notably, the regulation does not apply to all entities that are regulated by the Department of Financial Services. For instance, it doesn't apply to mortgage servicers or sales finance companies, but it does apply to that specific list of entities that I just listed. The regulation is split into two parts. You have transaction monitoring and then filtering component. An institution's transaction monitoring program is something that's designed to detect transactions that violate BSA or AML requirements and to detect instances that require the filing of a suspicious activity report, or a SAR as they're known. A filtering program, on the other hand, is designed to detect transactions that are prohibited by OFAC. That's the Treasury Department's Office of Foreign Asset Controls. The DFS regulation requires institutions to have transaction monitoring and filtering programs in place that are reasonably designed to detect these transactions based on given financial institutions, which is based on the institution size, governance, businesses, services, products, operations, customers, other relations and their locations, as well as the geographies and locations of the institution's operations and business relations. Next slide, please. As Matt explained in his segment, the geographic targeting orders have been used as a very important tool by FinCEN, especially the residential real estate geographic targeting orders that require title companies to report beneficial information on legal entities that are used to purchase residential real estate above certain monetary thresholds. The first of these geographic targeting orders were issued for Manhattan and Miami, and the geographic targeting orders were expanded from there to include all 5 boroughs of New York City, 2 additional counties in the Miami area, 5 counties in California that include Los Angeles, San Francisco, and San Diego, the Texas county that includes San Antonio, and as Matt had explained, most recently Honolulu getting added to this list, this past August. In New York, the geographic targeting orders came at a time where developers were building a lot of new luxury buildings, with many individual apartments that were coming onto the market priced in the millions, some in the tens of millions of dollars. The geographic targeting orders are only one factor, of course, but the luxury residential real estate market in New York has been cooling. There are plenty of articles that you can read on that if you're interested. And the market has been cooling over the last few years, and right now there's somewhat of a flood of inventory on the market, which is having economic consequences on the entire residential real estate market here in New York and related industries as well. Next slide, please. In early September, the New York Department of Financial Services entered into a $225 million settlement with Pakistan's largest bank, Habib National Bank, pursuant to the new regulation on transaction monitoring and filtering. Habib National Bank was licensed by the Department of Banking, which is DFS's predecessor, back in 1978. And in 2006, Habib Bank entered into an agreement with the banking department arising out of what were deemed to be significant deficiencies regarding the bank's compliance with economic sanctions law and with its anti-money laundering compliance, including violations of the Bank Secrecy Act. In 2015, the Department of Financial Services examined Habib Bank and found that their compliance function was even worse than what was found back in 2005, and actually had deteriorated significantly since 2005. As a result, the Department of Financial Services and Habib Bank entered into a consent order for remedial actions and the hiring of an independent consultant to conduct a look back of Habib Bank's U.S. dollar clearing transaction activity from October of 2014 to March of 2015. Next slide, please. The Department of Financial Services examined Habib Bank in 2016, and the bank was given the lowest possible exam score, which was a 5, due to significant weaknesses in the branch's risk management capabilities and Habib's failure to implement controls to mitigate and manage BSA, AML, and OFAC risks. The investigation found that Habib Bank committed egregious compliance errors, including facilitating billions of dollars, that's billions with a B, in transactions to a Saudi bank with reported links to Al-Qaeda, and facilitating the rerouting of a transaction by an individual prohibited from using the U.S. financial system, so that that transaction could then be resent in a method that would allow the individual to intentionally omit the prohibited, his name, the prohibited party's name. Next slide, please. The Department of Financial Services had originally sought a penalty against Habib Bank of $630 million, but the parties eventually agreed on $225 million, along with the surrender of Habib Bank's New York license and the closure of their New York branch. The settlement was separately announced by both sides, with each side obviously claiming victory. It was championed by DFS as being a tremendous victory for the people of New York, and Habib Bank was able to spin the settlement by saying that they were in fact exiting the New York market because the cost of compliance in New York was too high. Next slide, please. As part of the settlement with the Department of Financial Services, Habib Bank is subject to an expanded look back by the independent consultant that they had hired and who was approved by the Department of Financial Services pursuant to the 2015 examination. The additional look-back periods for the independent consultant are October 1st of 2013 through September 30th of 2014, and April 1st of 2015 through July 31st of 2017. And the Department of Financial Services obviously retains the authority to impose any new penalties following that expanded look back. Next slide, please. Another recent anti-money laundering enforcement action came from FinCEN and involved a virtual money exchange known as BTCE. BTCE was an internet-based exchange for old-fashioned fiat currency as well as virtual currencies, most notably Bitcoin and Ethereum. Earlier this year, FinCEN assessed a penalty of $110 million against BTCE and $12 million individually against the company's operator, who was a Russian national named Alexander Vinnik. FinCEN had coordinated this enforcement action with the U.S. Attorney's Office for the Northern District of California, which is not uncommon for FinCEN to work hand in hand with an investigating Attorney General's office. Next slide, please. BTCE was not a typical enforcement action by FinCEN standards, and that's because typically what you see in the FinCEN enforcement actions are that a company lacked proper controls, or a company did something, took steps that left it vulnerable to customers of the entity to do money laundering, to clean their money through that entity. In this case, though, BTCE was found to actually have facilitated the money laundering. And FinCEN determined that BTCE failed to properly identify its customers, actively embrace the pervasive criminal activity that was conducted on the exchange, and even advised its customers on how to launder money. For example, BTCE had a comment forum where people would talk with one another about the methods for laundering money from drug sales that were made using dark net markets, such as the most common of which is Silk Road. BTCE did absolutely nothing to police or to monitor those comments, and actually let it go. One of the things that, next slide, please. BTCE was determined to have processed over 300,000 Bitcoin in transactions traceable to theft, and this includes funds that were stolen from Mt. Gox and from elsewhere. Now, 300,000 Bitcoin is not the equivalent of $300,000. Bitcoin trades somewhere around $5,000 per unit right now, so that amount is pretty hefty there. Mt. Gox, you may or may not remember, was another Bitcoin exchange that actually started out as an exchange for currency that was earned through people engaged in the game of Magic the Gathering, and that exchange was robbed of millions of dollars worth of Bitcoin. As was often said at the time, Mt. Gox is an electronic exchange. There is no mountain, there is no location known as Mt. Gox. It was only a virtual exchange that originally started out in Magic the Gathering, which is where you get the acronym of Mt. Gox. BTCE was also determined to have processed transactions totaling at least $3 million related to ransomware attacks. Ransomware is I'm sure many of, if not all of you know, is the practice of infecting a computer or a network with software or with a virus that prevents the users from using either their computer or the network until money has been paid to the attackers. Typically, the money is paid in Bitcoin or some other virtual currency, and ransomware attacks have had a major impact on not only individuals, but on businesses of all types and sizes. And with that, I'd like to thank you all for your time. As I turn it back to Sal, I believe we will be fielding some questions right now.